My pockets are empty. The journey begins. One step at a time toward the future. Step 1 isn't investing, it's stabilization. Before assets grow, foundations must hold. Without financial stability, investing becomes gambling. Stability begins with cash control. Track income. Track expenses. Know your numbers. Clarity precedes control. If you don't control cash flow, you cannot build capital. And capital is the seed of every portfolio. Step 2. Eliminate destructive debt. High-interest debt compounds against you. Investing compounds for you. Choose your direction. Credit cards charging 20% interest are not investments. They are anchors. Remove anchors before you attempt to sail. Step 3. Build an emergency fund. 3 to 6 months of essential expenses. This is not optional. It protects your future portfolio from panic decisions. An emergency fund buys patience. And patience protects investments. Without it, every setback forces liquidation. Now, and only now, you are ready to begin building. Not trading. Building. The journey from broke to portfolio is not dramatic. It is structured. Let's map it step by step. Step 4. Open an investment account. Not tomorrow, not when you feel ready, now. Access creates momentum. Choose simplicity over complexity. For beginners, diversified index exposure is often the foundation. Broad ownership reduces risk concentration. For example, broad market funds that track benchmarks like the S&P 500 represent ownership in hundreds of companies. You are not betting on one winner. You are participating in economic growth. Step 5. Automate contributions. Even $50 per month builds identity. Consistency matters more than size. Your first $1,000 invested is not about money. It's about proof. Proof that you are now an investor. Do not obsess over returns yet. Obsess over process. Process creates results. Ignore market noise. You are early. Volatility is not your enemy. Inconsistency is. Reinvest dividends. Let growth feed growth. Compounding begins quietly. At this stage, patience matters more than prediction. Stay invested. Stay systematic. You are no longer broke. You are building. That identity shift changes everything. Once your first contributions are consistent, the next lever is not higher returns. It's higher income. Most beginners focus on squeezing performance out of small capital, but capital growth begins with earning power. Investing $100 per month is powerful. Investing $500 per month is transformational. Your savings rate often matters more than your stock selection in the early years. Focus on skills, certifications, negotiating salary, side income streams. Increasing your income expands your investing capacity. Your portfolio is a reflection of surplus. No surplus, no scale. Build margin into your life. Margin funds freedom. As income grows, raise your investment percentage, not just your lifestyle. Lifestyle inflation is the silent killer of future wealth. Now we structure your growing capital. Start simple. A core diversified equity position, often broad market exposure, forms the base. Many beginners use low-cost index funds aligned with benchmarks like the S&P 500 as their core. Not because it's exciting, because it's efficient. Your portfolio starts with a strong core. Then you layer additional exposure, but only after the core is strong. Avoid overcomplication. Too many assets dilute clarity. A simple portfolio held consistently often outperforms a complex one adjusted emotionally. At this stage, your focus is allocation, not speculation. Balance risk according to your timeline. Longer horizon allows greater equity exposure. Shorter horizon demands stability. Whoa, a top performer! Trap 1, chasing performance. The fund that just outperformed often underperforms next.
Recency bias is expensive. Oh,
Trap 2, panic selling. Markets fall. That is not a glitch. It is structural. Your emergency fund exists so you don't liquidate investments under pressure. Trap 3, constant checking.
come on, move up!
Daily portfolio monitoring magnifies anxiety. Steady growth. Good. Quarterly review is often sufficient for long-term investors. Trap 4. Your job is not to beat the market every year. Your job is to remain invested for decades. Longevity is your advantage. Somewhere around year 5 to 7, something changes. Your contributions still matter. But now, growth starts contributing too. Compounding shifts from invisible to undeniable.
At first, you built the portfolio. Now the portfolio begins building itself. Dividends reinvest. Gains compound. Momentum replaces effort.
This is where most people finally understand patience. Not emotionally, mathematically. Time was never the enemy. Impatience was. If your foundation includes broad market participation, often through diversified exposure aligned with benchmarks like the S&P 500, growth reflects economic expansion itself. You are no longer chasing winners, you are participating in progress. And now something powerful happens. You stop asking, how much did I make this month? And start asking, how strong is my system? Once your core portfolio is stable, you may begin layering additional assets. Real estate, business equity, retirement accounts. But never at the cost of stability.
Diversification is not about owning everything. It is about reducing dependency on one outcome. Multiple income streams create resilience. As assets grow, risk management becomes intentional. Insurance, asset allocation shifts, rebalancing annually. Structure replaces randomness.
You are no longer reacting to markets. You are managing capital. That distinction marks the shift from beginner to investor. And here is the quiet truth. Wealth rarely feels dramatic while it's forming. It feels disciplined, measured, ordinary, until one day, it isn't. Remember where you started. No system, no assets, no clarity, just intention.
Now you own productive assets. You contribute consistently. You think in decades. That is transformation.
From broke to builder, from reactive to strategic, from consumer to owner, identity precedes wealth.
The journey was never about predicting markets. It was about designing behavior, systems, patience, commitment. That is the real portfolio.
If you follow this roadmap, stabilize, contribute, structure, scale, protect, you don't just build a portfolio, you build freedom. Because investing isn't about being rich, it's about being independent. If this channel helps you think differently about money and build with clarity instead of noise, consider subscribing for more structured, long-term investing insights. We don't chase hype here, we build systems. I'll see you in the next video.